This video is going to focus on range bars and specifically range bar entry methods. A range bar is unlike a time-based bar like 5-minute, 15, 30, hourly, in that each bar is made up of X number of pips per bar. When the markets are dead, you can see there's very little distance between each half-hour period, and when the market's more active, you have a wider bar period right here. From 4 to 4:30, it was the most active in terms of distance. A lot of these bars went up 6 pips, down, up, down, and so forth. And so because it's based on movement, you only make money or lose money when price moves. I really like range bar charts. There's a lot of ways to use these. For one, at and above and beyond the lower containment bands or above the upper containment bands, price tends to reverse. And specifically, if you can get a 3 to 5 bar sideways rectangle pattern, when it goes above those bars high, it's usually a pretty decent entry pattern. Also, right here with the hourly. Came up to the hourly and found resistance. There was some selling, which there normally is. There's also a 10-day moving average right here. But you have a nice little rectangle pattern that you can spot on your chart. And at key areas like this, when it breaks out above there, you can go long. And on this, I have my intelligent trailing stop, which is designed for range bar charts. Yeah, as long as the momentum is there, which you can clearly see below, it has a very nice stop. Another thing I like about range bar charts, let's go look at some other examples here. So a similar pattern here happened in the pound dollar. The weekly trend's up, the monthly trend's up. This one had a nice little sideways rectangle pattern for quite a while, and it broke out right here. And you can see you would have been short around 57.50. It came down, and it found support at the lower containment band. Then it exploded up. This is one of those areas where it's very likely to reverse. You can see it also came up and found resistance at a monthly pivot, hourly moving average right here. When it broke above right here, you can go long, and it went up 20 pips. One other method that I like is when it pulls back and you get 3 to 5 bar red bar pullback. When the trend's up, 3 to 5 bar pullback, and I prefer 4 and 5 personally. As soon as you get one green bar and it goes 1 pip above that bar, you go long. Now, not every trade's going to make you money, but this is a very low risk entry method where you're risking literally 6 pips plus 1 pip padding. In this case, it went up a pip or 1 bar, the second bar, and you can see it had no statistical strength. You might have moved your stop up. This is one of those instances where you might only lose 3 or 4 pips to get into a trade, and you have the exact same pattern here. 3 bars down, 1 green bar, you wait for it to go a pip below above the high here at 54, put your stop underneath the low, and it found support here, and it took it quite a while, but then it exploded up, and you can see it went up about 80 pips. So you lost 3 or 4 pips on the first one and then made 80 pips on the second one. And anytime you're in a trade, if you don't see some momentum come in where you have more green than red, you might want to get out of the trade with a small 3 to 5 pip loss. So this also shows another multi-hour sideways rectangle pattern right here. And when it finally breaks out right here, you can go long. And look at how beautiful the intelligent trailing stop is on a range bar chart. Now the 3.0 green containment band is usually the end of the move. And so if you want to look for counter trend trades up here, if you get a nice little 3 to 5 bar sideways rectangle pattern, when it breaks down right here, you go short. This isn't the biggest trade in the world, but you're short at 53 with your stop right above the high here. And you can see it pulled back. You might have only made 10 pips on that trade, but it's a pretty high probability trade. Here's some other rectangle patterns that you can see very clearly on the chart. And when they break out from these, the tighter and the more closely formed, the better. Also note the lower containment band. You have a nice little rectangle pattern right here, and it exploded up. Later in the day, you can see it was quite strong. Keep in mind that this one has a daily, weekly, and monthly trend that's for the most part down. But once the market pulls back 3 bars and goes green, you have a small loss right there. And guess what? 3 red bars followed by green. You go long here at 85, and the second trade got you out at 40. So you made 55 pips on one trade and maybe lost 6 to 10 pips on the first one. So And again, you have a multi-bar pullback right here, one green bar. When it goes a pip above there, you go long with your stop underneath here. It starts going up. It's not quite as strong as it was before, and we're above our upper containment band. As you're watching this in real time, you can observe price movement. If you're in a trade and you want to get out of half your trade with 5 or 6 pips, put your stop to break even. There's instances where you have small losses like that. Here's another one, multi-bar pullback, red, first bar that's green. You wait for it to go a pip above here. Your stop would be a pip or two underneath the low. And again, it's not the biggest trade in the world, 24. It went all the way up to 44. It went up 20 pips. If you saw it go up here and then come back down, you can always move your stop underneath those 2-bar low right here at 37. But at least you made 10 pips on that trade. And notice a 3-bar pullback, green, wait for it to go above here, put your stop underneath the low, and usually you want to put it a pip or two underneath the low. It's possible you got out of that trade here with a small loss. But it's also nice for doing counter trend. Above the 2.0 white containment band, specifically the 3 times containment band, which I like to label green, the market's very likely to reverse. If you get a multi-bar sideways range like this and it breaks down, you can go short at 57 and use the trailing stop, to get you out. You're already locked in almost 30 pips in this trade so far. Notice the nice rectangle pattern at the lows, at the containment band. And then the market went up. And specifically, anytime it comes up, down, and touches the top and bottom of the range a couple times, that's pretty high probability trade. When it breaks down right here, you're short. This didn't really lead to too much profit. 94 out here at 90 if you use our trailing stop. You also had the same exact pattern right here. Up, down, up, and then when it broke out, notice you were long. It almost stopped you out, but it didn't. And then the market exploded up about 80 or 90 pips. And the nice thing about this is during any strong trend, it does an exceptional job of having a very tight stop. Notice how tight this trailing stop is. It's ridiculous. I don't think you'll find anything out there in the market that has as tight of a stop as this and doesn't get snagged out of the market that much. It's statistical in nature. It knows statistically how strong the pound is and weak the yen is. If the pound is stronger than the yen, it has a wider stop. If the market moves statistically too far, we tighten the stop. If the momentum changes from up to slightly less up, we also tighten the stop. So there's a lot of code in here that knows when to have a wide stop and when to have a tight stop. If the market moves statistically too far, it tightens the stop. If the market's momentum slows or reverses, it also tightens the stop.